The titans of Wall Street are bleeding. The entity that supposedly owns the world, BlackRock, is in serious, undeniable trouble. Just a few weeks ago, the unthinkable happened. They realized a 100% total loss on a loan they had categorized as perfectly safe, a loan they swore was guaranteed to be paid back in full just 20 days prior. The veil has been lifted, exposing BlackRock not as the invincible master of the universe, but as an extremely delicate house of cards waiting for a stiff breeze. But now, the rot has spread. The situation has devolved from bad to catastrophic. BlackRock's own crown jewel, their private credit fund, has failed so spectacularly that they are literally paying their own customers out of their own pockets just to stop a run on the bank. This failing instrument isn't new. It is a collateralized loan obligation fund. If that sounds familiar, it's because it is basically the exact same financial weapon of mass destruction that evaporated the global economy in 2008. So, in this video, I am going to pull back the curtain and explain exactly what is happening in the shadows, why BlackRock is facing an existential crisis, and, most importantly, what is likely to come next for you and your money. Let's look at the hard evidence. Let's establish the baseline reality so the mainstream media can't accuse us of bias. This information comes directly from Bloomberg terminals, hidden behind paywalls that they hope you never see. A massive portfolio of private credit loans managed by BlackRock has performed so abysmally that the money manager has been forced to waive its own management fees. In the credit world, this is a rarity. It is a desperate signal of distress. Here is how the machinery works. BlackRock funds these massive loans by selling bonds known as Collateralized Loan Obligations, or CLOs. The deal is simple. The portfolio must perform well enough to pass a series of strict stress tests regularly. If the portfolio fails to clear these hurdles, it triggers a mechanism that forces BlackRock to take drastic action, usually by diverting interest income away from the risky bets and funneling it toward the so-called safer securities to prop them up. In October, the value of this portfolio plummeted. It fell hard enough to breach what is known as an overcapitalization test, or an OC test. In plain English, the value of the loans backing the system was too low compared to the bonds they sold to investors. The vehicle was insolvent. To fix this breach, they had to defer their own fees and siphon cash from the risky tranches just to balance the books. This information comes from insiders who are terrified to speak publicly. Failing an OC test is not a minor glitch. 4 high-rated tranches of a CLO, it is practically unheard of. These instruments are sold on the premise of resilience and self-correction. While the bondholders haven't technically lost their principal yet, this failure is the smoke signal before the fire. It raises terrifying questions about the entire private credit market, a sector that has mushroomed in the shadows over recent years and is now cracking under its own weight. So what is this beast? BlackRock manages a fund that invests in CLOs. Let's strip away the Wall Street jargon. You take a normal loan, usually backed by a company's assets rather than a house, and you look at this diagram BlackRock posted on their own website. You take 100 of these risky corporate loans, you throw them into a blender, package them into one giant financial product, and you sell that package to investors who are too blind or too lazy to look inside the box to see what they are actually buying. The sales pitch is that by bundling them, you reduce risk. However, only about 1/3 of the loans inside this CLO, which is headline listed as AAA rated, actually deserve that rating. The rest? They are toxic. They are junk. And if you have a memory longer than a goldfish, you know this is literally exactly what happened during the global financial crisis of 2008. The only difference is the label. Back then, they called them MBSs, mortgage-backed securities. They have changed the terminology to hide the crime. But we will get to that. Why is BlackRock, the supposed adult in the room, playing in the same radioactive sandbox that destroyed the world economy 15 years ago? Let's hear their excuse. They claim that investors are flocking to CLOs because their floating rate coupons offer protection from volatility. Protection from volatility. Remember that phrase. They also claim you get higher yields compared to corporate debt. They say because there are so many loans bundled together, the risk is diluted. Today, CLOs are not a niche gamble. They have matured into a $1.2 trillion market globally. Actually, that number is outdated. At the time of this recording, the monster has grown even larger. The reason the elites love this market is precisely because it is the private credit market. It is the gray market. It is opaque. It is not held to the rigorous standards of public investments where a stock price flashes on a screen every second, telling you exactly what something is worth based on buyers and sellers. This lack of transparency is a feature, not a bug. It's great for the sellers because they can tell investors they are getting steady returns without the volatility of the stock market. BlackRock can look you in the eye and say their loans are solid as a rock, guaranteed to pay out. But here is the dark truth. Because these loans are private and do not trade on a floating market, the investors never know the true value of the asset. They only know what BlackRock says the price is. This is a system called mark-to-model, or as I like to call it, mark-to-fantasy. BlackRock can claim the portfolio has gone up in value, and they don't have to prove it until they actually have to pay the investors back. Let me show you how ridiculous this fraud has become. I am going to pull up a specific example from one of BlackRock's own CLOs. This is the iShares BBB-rated CLO active ETF. The headline says triple B, which sounds decent, but inside, it holds tranches of debt rated all the way down to B, junk status, that anyone can buy into. BlackRock claims the 6-month performance of this fund is a positive 4.5%. In the world of fixed income, that is a miracle. But let's open the box. Look at the data they provide. We have market value, notional value, and par value. Par value is what the debt is actually worth on paper, like a $4 million commercial mortgage. But look at the market value column. It shows a value of $4,038,540. It supposedly went up in value. Now, a market value implies that is the price someone is willing to pay for it right now. But this asset doesn't trade. There is no market. So where did that number come from? Look at the notional value tab. It is identical down to the penny. The market value is just a number BlackRock typed into a spreadsheet. They decided, arbitrarily, that this debt increased in value by 1%. This is the scam. It is the same across every security in this CLO. A $2.5 million loan, suddenly worth $20,000 more. A $1 million loan, suddenly up by $21,000. None of these securities are free-floating. None of them have a real price tag attached to them by a buyer. BlackRock is marking up their own homework to get an A+. Context is everything. Right now, in the United States, corporate bankruptcies are hitting levels we haven't seen since the Great Recession. The private credit sector has seen multiple multi-billion-dollar collapses in just the last few months. The jobs data is being revised downward constantly. The only thing propping up the illusion of growth is the AI speculative bubble, which is fueling circular, fraudulent investment into data centers. Yet, in the face of this economic deterioration, BlackRock wants you to believe that the underlying value of the loans in their B-rated CLO, the riskiest junk imaginable, has increased over the last 6 months. They are claiming that the companies holding these debts are more likely to pay them back today than they were 6 months ago, despite high interest rates and a cooling economy. It is an insult to your intelligence. The point is that BlackRock gets to decide the reality. We are forced to take them at their word, right up until the moment a loan stops paying altogether. That is the only moment the truth comes out. When the cash stops hitting the account, BlackRock has no choice but to admit to the world that they were wrong, that the loans were worthless for months, and that they were lying to us the entire time. Let's return to the specific news event, the failure of the BlackRock Baker CLO 2021-1. Why did it fail the overcapitalization test? Because reality finally caught up with the spreadsheet. This CLO contains loans to a list of companies that are currently dying. One of them is Renovo Home Partners. I spoke about them recently. They filed for bankruptcy earlier this month. Overnight, BlackRock had to revise the value of that debt from 100 cents on the dollar down to zero. Just weeks prior, they told investors it was perfectly safe. They hadn't adjusted the notional value until the company literally ceased to exist. Another loan inside this toxic bundle is to Pluralsight, an educational software provider that lenders had to seize control of. Another is Astra Acquisition Corp., which filed for Chapter 11 bankruptcy in September. This isn't a one-off event. The higher-rated debts in this CLO tripped their OC test last October, cured it, and then failed again. The risky bonds, the toxic waste at the bottom of the barrel, have been failing their tests continuously since April 2024. S&P Global Ratings finally woke up and downgraded the junior tranches, citing deteriorated credit quality. This specific CLO was priced at $495 million in late 2021. It was launched into a market that was flushed with cash, where lenders were fighting to give money away, relinquishing all safeguards just to win business. They piled on leverage. They ignored risk. And now, the bill is coming due. The CLO market was worth $1.2 trillion recently. By next month, it will likely hit $1.7 trillion. There is a stampede of capital rushing into this burning building. Investors are desperate for yield, taking on more leverage and risk, unaware that they are buying into a collapse in real time. BlackRock isn't just dealing with one bad fund. They recently acquired HPS Investment Partners and immediately had to zero out roughly $150 million in debt. Yet, the machine keeps churning. More than 1,000 new CLOs worth over $470 billion have been priced this year alone, breaking last year's record. While banks used to dominate this space, now private credit firms, shadow banks, have muscled in. They are securitizing loans to smaller, riskier firms and selling them off to pension funds and ETFs. BlackRock has created 29 different CLOs in the last couple of years. All of them are priced using the same fantasy math I showed you earlier. The CLO that just failed, the one that literally ran out of cash to be legally compliant, was rated AA. That is the second highest rating possible. Let that sink in. A AA rated investment went to zero overnight. Most of BlackRock's other CLOs are rated far lower. If the safe stuff is failing, what do you think is happening to the junk? It is overwhelmingly likely that this is the catalyst for the next global financial crisis. The system is hugely overleveraged, based on complicated instruments designed to confuse you. Calling something BBB sounds safe to the average person, but in the CLO world, it's a gamble. Calling something B- sounds okay, but it is actually the bottom of the barrel. The vast majority of people buying these ETFs have no idea what they are holding. We are staring down the barrel of two outcomes. Option A, an outright, open bailout like 2008, where the financial institutions collapse and the taxpayer foots the bill. Option B, infinite money printing, similar to the COVID response, which leads to hyperinflation that destroys your purchasing power. Either way, the Western economies are in dire trouble. Governments will be incapable of not stealing from ordinary citizens like you and me to pay off the gambling debts of the private credit industry. They will rob your savings through inflation or taxes. This is why I am so paranoid about how I protect my assets. I am focused on squirreling away as much capital as I can while the sun is still shining on my online business. I believe it is vital that we recognize the storm clouds and prepare. Because it is going to get bad. Let's go back to history for a moment. In the wake of the 2008 crisis, the banks realized the gig was up. They got their bailout, but regulators told them they couldn't leverage up on mortgage-backed securities, MBS, or collateralized debt obligations, CDOs, anymore. But Wall Street is addicted to easy money. They didn't want to stop. So, they just switched tactics. They rebranded the exact same toxic sludge as something new. MBS became ABS, asset-backed securities. CDOs became CLOs, collateralized loan obligations. They are, functionally, the exact same thing. The only difference is the marketing budget and the naming convention. ABS should sound familiar because they have been in the news lately with the collapse of Tricolor Holdings. Tricolor was in the business of handing out car loans. They packaged thousands of these loans into asset-backed securities and sold them. But Tricolor was running a scam. They were issuing car loans to illegal immigrants and ghosts, people with no social security numbers, people who had zero ability to pay the loans back. The statistic is mind-bending. 62% of the people who took a loan from Tricolor didn't even have a credit score. Tricolor took this insane risk and multiplied it. They put the same loans into multiple different securities at once, selling the same asset 2, 3, or 4 times over to different investors. They were quadrupling their profit on a loan that was never going to be paid back. When this fraud was exposed, Tricolor went bankrupt. Billions of dollars had to be written off by financial institutions, including JP Morgan Chase, who were stupid enough to buy this garbage. Let's look at how these Tricolor securities were rated. Remember, 62% of the borrowers had no credit score. Yet, look at the ratings S&P Global gave their 2025 securitization trust. Class A, $131 million worth of loans. Rated AA, Class B, rated A-. Class C, rated A-. 80% of this bundle of toxic loans was rated A- or higher. Supposedly very safe. S&P Global issued this rating back in June, stating that under a moderate stress scenario, everything was within credit stability limits. 3 months later, the company collapsed. In fact, another rating agency, one paid to actually dig deep, found out about the 62% figure. S&P Global admitted the only reason they didn't give these loans a AAA rating was because Tricolor had grown too rapidly. It wasn't because the borrowers were ghosts. It wasn't because the collateral was non-existent. This proves that the rating agencies are just as complicit today as they were in 2008. They are stamping gold standard on bags of manure. The bad news is relentless. This isn't just about BlackRock or Tricolor. Look at the timeline of failures. First, we had Greensill, an early warning siren a few years ago. Then Zip's car wash collapsed in early 2025. Then First Brands Group, Renovo Home Partners, Western Alliance Bancorp, Zions Bancorp. The trend is simple and undeniable. There is a mountain of bad debt out there that borrowers cannot afford to repay. When they miss those payments, the trillions of dollars in assets based on those debts evaporate. The reason it comes as a shock every time is because of the secrecy. Shadow banking and private credit mean there is no price discovery. There is no supply and demand transparency. We are relying on the honesty of institutions like BlackRock to tell us when a loan is going bad. But why would they be honest? From their perspective, it is better to hide the rod in the basement, pretend the house is fine, and hope the economy turns around before anyone checks the foundation. BlackRock will delay the bad news until it is impossible to hide. The simple, terrifying truth is that there are trillions of dollars of bad loans currently sitting on balance sheets, marked as valuable assets, creating wealth. In reality, they are liabilities. They are fuel for a fire that is already burning. If you have thoughts on this, if you think I'm right, or if you think I'm crazy, let me know in the comments. I try to read every single one. And if you don't want to be blindsided by the next collapse, make sure you are subscribed. But the most important thing you can do right now is to wake others up. Share this video. Send it to a friend, a coworker, or a family member. Help them understand the debt bubble that is about to burst. Help this channel grow so we can keep exposing the truth. There is a serious, systemic problem in the credit markets. U.S. bankruptcies are at post-2008 highs. REITs are crumbling. Shadow banking has come for the giants. And now, the cherry on top. Even BlackRock is feeling the pain, forced to write off millions in a desperate attempt to keep the charade going. The clock is ticking.